Hello and welcome to the Databank video for the April issue of The Banker. I'm David Robinson, the online editor at The Banker. And today we're looking at the Chicago Board Options Exchange Volatility Index, the VIX for short, otherwise of course known as the Fear Index. With me to discuss this is Marie Kemplay, Capital Markets Editor at The Banker. Now, the VIX measures expectations of price volatility within the S&P 500. It's the key gauge of stock market instability. And last year, the VIX went through the roof. So, Marie, what's going on and what does it mean?
The VIX is a key measure of volatility, and it's really used as a way to gauge investor sentiment. And it's often referred to as, the fear index for that reason. So at a basic level, a higher VIX obviously implies higher volatility. And it's, I'm not going to get into the technical intricacies of this, but it's all kind of calculated based on call and put options within the S&P 500. And if the VIX is high, traditionally you would expect there to be a kind of stock market kind of fall after that. That isn't always the case. Sometimes it's the opposite can happen. There'll be a higher VIX and you might see prices climb as well. So it's not a perfect indication, but there's a pretty good correlation there. And as we know, 2020 was obviously an extraordinary year in so many ways. And I think it was, in March last year when it really became clear to everybody that COVID-19 was going to have a significant impact across kind of Europe and the US particularly. And at the same time, investors kind of panicked, and we saw the stock market kind of take a massive dive at that point in time. And so not surprisingly, in March last year, the VIX was at a very elevated level, and it actually spiked to 82.69 on the 16th of March, which is a record high. And in fact, according to analysis by US Trade Association, SIFMA, 5 out of the 10 highest ever values for the VIX were recorded in March last year. For context, the other 5 were in October and November 2008, which obviously was the height of the financial crisis. And all of those values, all 10 of them, were above 70. And again, for some context, a kind of normal or kind of average VIX would be around 20. So, that gives you an indication of how much higher those values were. But March last year was a pretty extreme month. Markets, as we saw, did kind of calm down, and the VIX did actually gradually decline throughout last year to end the year at 22.37 as an average for the whole month of December. Although it is worth acknowledging that it did end the year actually 82.4% higher than it started the year, and the average for every month except for January during last year was actually higher than the average for 2019. So I guess in basic terms, what I'm saying there is it was a kind of elevated year of volatility kind of throughout the year to a certain degree.
How has the volatility panned out this year, and how does it compare for last year, and how should investors look at this?
I think it's fair to say everybody was probably expecting this year to be a bit kind of calmer than last year. We haven't necessarily seen that so far, as viewers are probably well aware. We've seen quite a bit of a trading frenzy in the US stock markets around certain stocks in particular, these so-called meme stocks like GameStop. So actually, we did see the VIX spike again at the end of January around that kind of activity. It spiked at 37.21, which, as a reminder, anything kind of above 20 is generally regarded as kind of getting into the high levels. So yeah, although not spiking at levels as high as last year, that's still pretty high. It has now kind of started to calm down again, following a few smaller peaks in late February and early March. But I guess the broader message to take away there is, if we were expecting 2021 to be a kind of completely calm year with kind of low volatility, that isn't necessarily going to be the case. So yeah, hang on to your seats again, I'd say.
Here's hoping for a slightly less volatile period in the months ahead. Marie, thank you very much.